We have 21.
All right. Assalamu alaikum, everyone. We're just going to give a few minutes just because people are still joining in, and then just stay tuned. All right, I think that's enough time for people to come in, and then people can just keep joining in as they come in. Assalamu alaikum, everyone. Welcome to the Wine Professional Development Series, the next episode, which we're going to be talking about halal investing made easy today, which is a great time. You know, just reading the chat box, looks like there's some hype because of the recent events, but. I'm Raheem Ashrafi, and I'm from YM Chicago. I've been going to YM for, I believe, like 12 years, 13 years. So it's been a while, specifically from the west side, YM, that's around the IFS, Villa Park, Lombard area. And then Hamzah, I'll let you introduce yourself, the other host.
Okay. Assalamu alaikum, guys. My name is Hamzah. I've been part of YM for about 5 years now. I'm part of the Bolingbrook part of YM Chicago. Yeah, I'm super excited as well. Go ahead, Ryan.
Great. So we can jump right into it. So we have a guest speaker, Brother Saad. He's the vice president from Wahid Investing. Brother Saad, you know, he's given a lot of webinars, seminars. I've actually attended one in person, and I met Brother Saad in person a couple of years back. Great guy, mashallah. And Brother Saad, I'll let you talk about your like where you're from and introduce yourself and your experience, past experience.
Yeah, of course. Assalamu alaikum, everyone. And thank you, Hamzah and Raheem, for putting this together. I think you guys are doing an amazing work for the Muslim youth, I would say, across the board. So yeah, my name is Saad Zariff. I've actually been with Wahid Invest for about 3.5 years. This presentation is not going to be per se about the company I work for, but more about, as the topic itself suggests making halal investing easy. In other words, what does it take to be a halal investor? What does that involve? And maybe covering some of the important parameters about investing, the general stuff, so you have a better understanding of it. Career-wise, I actually started my career as an accountant, did that for a couple of years, and then very soon realized I did not enjoy just the whole aspect of auditing and bookkeeping. Nothing against anyone who loves accounting, but it's just something that wasn't for me. And this was something that just by chance happened, that I fell into an opportunity to work in a private equity space that took me to Switzerland and Spain. And then I moved to New York in about 2007, and then I'm working as a trader there. And then from there, fell into the private wealth management space. And then eventually the Sharia compliant investment space about 6-7 years ago. So born and raised in London, of Pakistani origin, studied accounting, and then fell into the space. So alhamdulillah, I have close to about 16 years of experience managing assets and so on. I spent a little bit of time with a firm called Morgan Stanley as well, where I managed some assets. But like I said, the last sort of 6 years, strictly working with Muslims, educating them about the right way to invest while still keeping their investments in line with their faith. So with that, we can move forward with this. I will suggest that I know that this is partially on Zoom and YouTube Live as well. So keep your questions coming. I believe Raheem and Hamzah will be kind of going through them. And inshallah, towards the end of the webinar, I will address the questions that you guys have. At any point, you guys feel like you can't either hear me or the presentation is slow, let us know so that the guys can inform me so that A, I'm not going too fast or too slow either. So I've done my introduction. And since I do work for a company that especially works in the Sharia compliant investment space, I'll briefly talk about them. And then I'm going to put the narrative out of why as Muslims it's important for us to invest. Then we'll talk about a little bit about the halal investing parameters, which is important to understand. Different type of investments account that usually people tend to get confused about what to invest in. And then we'll go into the meat of investing, understanding what mutual funds are, ETFs are, stocks, and so on. A couple of strategies, and then a key takeaway at the end before the Q&A. So I really hope you guys get to enjoy this presentation for tonight. So Wahid Invest is a one-of-a-kind digital investment platform. Technically, we're basically a robo-advisor. I sometimes explain it to people by saying that no, we don't have robots working behind the scenes. We're just using math and algorithms to create the best possible investment scenario for clients to invest in. Of course, you can't invest in individual stocks to the Wahid platform. They are pre-built, diversified portfolios that we have. And you can download the app if you haven't. It's a blue app because we have a white one, which is for international clients. We are a global firm, started out of New York. And now we are in pretty much most major countries like Malaysia, UK, and another 130 countries as well. Alhamdulillah. And we have over 14,000 clients in the US, actually. But you guys can gather more information through the website and the app. So that was that. These pictures are basically to give you a look of what we've done so far. I've had the pleasure of being on stage with people like Sheikh Yasir Qadi, top right corner. That was a very unique experience for me. Bottom left, one of the first Sharia-compliant robo-platforms to ring the opening bell at NASDAQ 2 years ago when we launched our own ETF, Halal, HLAL. Those are the ticker symbols for it. You can get it on Robinhood and elsewhere as well. So it's been a unique experience so far being in this particular space. So let's get to the meat of things. Why, as a Muslim, you should be investing, especially in line with your values? Well, number one, it gives us a voice, which is something we don't really realize at times, is things like shareholder advocacy or impact investing are terms that are not very new, but are not that old either. They allow you to have a representation in front of some of these corporations that you invest in as a shareholder. How? Through the annual shareholder meetings. So companies like Vanguard, for example, that manage trillions of dollars, have hundreds of millions of shares of Apple, Amazon, Google, and others. So when they have their shareholder meetings, Vanguard can potentially force them to change part of the narrative of their business if need be, or even lobby at the federal level in favor of or against certain aspects of a business. That gives them that power. As Muslims, we don't have that voice. However, we at Wahid intend to change that narrative. That even if 100,000 Muslims were investing through a Wahid platform or otherwise, or even through our ETF, that allows us to have that voice to represent ourselves and our communities in front of these companies to say, we disagree or we agree with what you're doing and we want you to change that narrative. the halal investment or the halal industry, the industry in general, is growing quite rapidly. It's literally over $70 billion is what the potential is. And to put it in perspective, if you guys are reading some of these points I have, the last paragraph is most important. Why it's important to invest in a halal community level is because by focusing on that, like I said, those industries and sectors, we can actually have an impact. And that's what it's all about. Like if even someone was to invest $1,000 or even $10,000, it's not about the dollar value, it's about the volume of people getting involved. Plus, you are still investing in line with your values. So you're avoiding sin stocks, you're avoiding businesses or activities as Muslim we should not indulge in, while still getting returns comparable to the broader market. And that's the whole idea behind it, is that having that voice, having the representation, which is important. Otherwise, we don't have one. So this is a slide that I've used many, many times before, and it actually works really well in putting the thought process of investing in your mind. So if I was to ask you guys, what would you say, what's your investment crutch? So in other words, what is it that would either stop you from investing or worries you when you're investing? You guys are free to sort of throw out some answers there. And Raheem and Hamzah, if you guys don't mind, please see if folks have any suggestions as to what either stops them from investing, or if they do invest, what worries them. If you guys can read out a couple of answers, that would be really helpful. This way, we're hopefully trying to get our audience involved with me as well. I have a habit of doing that.
Yeah, looks like the audience is really involved.
That's good to know. They're paying attention.
Yeah.
So think about it, like what could be potentially either stopping you from investing, or if you are investing, do you think you're worried or concerned at times? What could be the reasons behind it?
One brother said losing money, which
Okay.
I think is really fair.
Okay. Anything else? Maybe one more answer. Doesn't matter if it's
One of them
line
said that the halalness of the stock, so how halal a stock is.
Okay, the validity of whether it's ethically permissible or not. Okay, fair enough.
Yeah, and it looks like a few people are mentioning that halal versus haram.
The halal versus haram. Okay, so that's an important one. Uncertainty, fear of losing your investment is related to one thing and one thing only: money itself. As humans, it's innate in us to be emotionally attached to our earnings. And that's why even when it comes to the ethical part of investing, a fear of losing the investment is one thing, but that's the belief that we have. Hey, if I'm not sure whether investment is Sharia compliant or not, I'm not going to play the guessing game. I'm just not going to invest. That way, I'm also saving my money right now, even though I want to, but I'm not going to. So the reality is that we have a very strong emotional attachment. So the fact about losing money came up is a very common one. That means your fear is of losing on your investments is pretty much you're saying, I'm worried about losing my money. So it comes down to how you diversify and how you're investing. Whether you have what we call a core satellite approach that I will cover later. But this is the one thing to always remember. When you're investing, you want to focus on your goals as opposed to the emotional attachment to your money. So the moment you're able to dissect that and say, okay, I know the stock market is a volatile place. I know there are fluctuations in the market, but I have certain goals in mind based on which I'm investing. That's what I need to focus on. It will change how you look at your investments. So the biggest issue always is eliminate that emotional aspect and focus on the goals that you have set up. The moment you do that, what you will realize is that uncertainty in the stock market is normal. It can never always go up, nor does it always go down either. It may never stay stagnant either. So the moment you realize that uncertainty is normal, I've learned to remove my emotions from my investing. I now recognize that the market risk is real. What you just said, I believe, Raheem, brother, if I'm not wrong, if you mentioned it, that someone said that they're worried about losing money, that technically in our language is called market risk, the risk of potential fluctuation in the market. So the moment you recognize that, you'll be in a much better place. It also comes down to how you're investing. And that's something we can cover later in a little bit. So now that I've talked about this, I want to give you guys an example about what volatility or the fluctuation in the market that makes you think like you're about to lose everything looks like. Dow Jones is one of the indices out there, an index. Think of it as a deck of stocks that's publicly traded to reflect how these companies are doing. S&P 500 is one of them. Top 500 companies traded on the stock market. You can't just buy that index on its own. You have to buy it in a form of a fund that's replicating it. That's how you get to have access to an index fund, because they're more diversified. So volatility is real and it's here to stay. This is a real-time chart since inception up until 2 days ago what it looks like of Dow Jones. There are two things you guys are going to notice here. Number one, too many squiggly lines, up and down, up and down, up and down. And number two, no matter what, over time, it's actually going in an upward trend. The far right two highlights, one right after 2000 is the 2008 market crash. I was working in New York when that happened. I experienced it firsthand. I always talk about this because it was a unique experience for me. And that's what made me realize that there are other ways to invest and manage clients' assets rather than an aggressive way by just trading money, which was very normal there at the time. Up until now, which is even during coronavirus pandemic in March, April, it was a slight dip that we noticed when people were freaking out. And then the market gave over 56% return basically overall. So what this teaches us is the squiggly lines of up and down is where the stock market is playing with your emotions, i.e. your money. But if you stick to your goals and you have enough time, especially with the youth, you guys have, mashallah, 20, 30, 40 years potentially to invest, depending on your goals, you will be in a potentially good place because we've seen historically that no matter what happens, eventually markets do go up and they reward the patient. That's a fact. Between 2008 and up until last year, December, we were looking at over 490% return in spite of everything else. This year, we've been surprised by also how the markets have done. Last year, of course, with COVID and all, we were still in a good place. So volatility is real. That's the fluctuation in the value. As long as you accept that, you'll be in a better place. So with that, I know the title here says that sectors Wahid does not invest in, but this is general. One of the bigger questions is, like some of the brothers mentioned, about not knowing what to invest in. So this gives you a general picture. Anything as a Muslim we're not supposed to indulge in from a business standpoint. Why should you make money from it? Also, usurious institutions like banks, insurance companies that generate their revenue from interest. Now, here's the funny thing. One of them you guys will see is firearms. There's nothing wrong with holding firearms. It's the action of it that's questionable. That's why it fits the narrative here. Gambling, alcohol, excess debt, companies that are highly leveraged, that have a high debt ratio, will never pass Sharia compliance screenings. Where do these screenings come from? To your bottom right, those are the initials, and I will highly recommend for those that like to do their own research, look up AOFI. This is probably the autonomous authority when it comes to creating guidelines for Sharia compliant investments, especially for folks living in the Western world. They have what's called rule number 21. I believe it's publicly available on their website as well, that covers different guidelines anyone should follow to ensure that those investments are Sharia compliant. It's quite detailed, but there are two aspects to it. One is the line of business, easy. If I'm not supposed to drink alcohol, why the heck am I investing in a Budweiser stock? Number two, financial ratios, how much debt a company has, and also what other businesses are they investing their revenue in. There's a rule called the 5% rule, and I'm going to briefly cover that right now, where a business that could be a technology business may invest a portion of their revenue in an alcohol company. However, the overall revenue that they've invested compared to what they have and earned should not exceed 5%. If it exceeds 5%, it's not permissible. That's how interest income works as well. So that's what's called the 5% rule, basically, when you're investing. Because the reality is you have interest all around us. You have sin investments around you. How do you mitigate them? How do you limit that exposure? You can't completely ignore interest. You can't completely ignore debt, but you have to find ways to limit it. So AOFI, that works with scholars from all over the world, has an annual conference in Bahrain where they sit and discuss these guidelines and tweak them if need be, depending on socioeconomic environments around us. We actually have a governing Sharia compliant board on our team as well. One of the members actually sits on the seat with AOFI as well. And he created the index that are ETF tracks, FTSE Russell Sharia. So, mashallah, we're working with people that are very learned in fiqh and economics and finance, so they can make sound judgments for us. I can talk about investments all day long, but I've never studied fiqh. So my knowledge is limited about how the Sharia compliant aspect works. We work with them on that. And then we also provide, or any Sharia compliant investment platform, if you're investing through them, should offer you a purification report. What money to distribute to charity that you should not keep if it either has or potentially might have come from impermissible investments. So with that being said, let's get into the nitty-gritty of things. We've learned two important things right now. Emotional attachment to money, not a good idea. Volatility is real. That's part one. Second part is we now know what Sharia compliant guidelines are, what businesses should look like. We actually, on the Wahid Invest website, we have a journal section that has a really cool article about business guidelines and financial ratios. You guys can have a read on it. So it gives you a breakdown of what ratios we look at, basically. So let's talk about for those that may not be that well versed with investments, or if you are, but you're not really sure how to define a stock, mutual fund, or ETF. So a stock really is partial ownership in a business. If you buy one share of Apple, that makes you an owner of Apple. Even if it's at a microfinance, a sort of fractional level, that's what you're doing. Companies that choose to go public take a route of an IPO, initial public offering, then they go public in the stock market. They want people to buy their shares so they have more money available to invest within their business and grow. They can give you two types of rewards, and I'll cover this in a minute though. Either growth or income, and we'll touch base on that. But the whole purpose of a stock is to have ownership in a business that's publicly traded by acquiring their shares. That, in a nutshell, is what it is. Now, how many types of stocks are there? How do you know which one to invest in? Well, this gives you a breakdown of that. You have large cap stocks, companies that are large and stable, Coca-Cola, Pepsi, Intel, Salesforce, and others. Established companies, very stable. Their stock value does not fluctuate too much at all. Then you have growth stocks, companies that are still in the growing phase, like Etsy and others perhaps, that still have potential to grow. So they give you revenue by their share price increasing. Then you have dividend paying stocks. Companies like Apple that fall in multiple categories actually give you a dividend income. What's dividend? Apple makes revenue. They actually recently crossed, I think, the $100 billion mark for the quarter as well. So that's been phenomenal for them. And they'll say, look, you know what? We made some good money. You are our shareholders. We want to reward you by believing in us and investing in us. We'll give you a small portion of our revenue. That's called dividend. That's an income you have earned by investing in them. So there are two types of investments ideally people look for: growth and income. When you think of growth, you're thinking about the share price of a stock growing over time. That will give you that sort of gains. Second is, doesn't matter what the stock does, you're getting your monthly, quarterly, biannual, however they decide to pay their dividends, that is coming in, which allows you income. Now, there are other types of stocks that people like to invest in. Cyclical stocks. These purely depend on the health of our economy. If the economy is doing well, these stocks will do well. If it's not doing too well, they might not do too well either. Sometimes mid-cap or small size companies fall in that category as well. Defensive stocks, think utilities. They are usually defensive stocks. They offer products and services that we always need. We need electricity. I can't do this webinar without it. So that utility becomes a defensive stock. It will work in most environments. And then something that at times people like to trade in, which are penny stocks. These are really cheap stocks, less than $5 per share. They may not be liquid enough. And when I say liquid, it means that you can't easily sell them in the market because there are not many people looking to buy them. It's a buying and selling environment in a stock market. The more liquid a company is, the more shares they have, the easier it is to buy and sell. Penny stocks are not that liquid. That's why they're also high risk. Unless you really understand them really well, it's not something, even as an individual, I would tell people to indulge in. Unless you do, you need to be okay with what you're about to lose, because you could potentially lose everything in that. So that's a bit of a gist about stocks. So now that we've covered that, let's talk about what I was saying: large cap, maybe medium cap or small cap. What is the different type of market caps? In other words, this is the term you guys will hear a lot if you're investing, or you have heard that. What's the market cap of Apple versus Uber versus other companies that are publicly traded? What's their value in the market, how much they're trading at, or their value overall, depending on their size. So we start with the far left, with the small cap companies have usually a value of 300 million up to 2 billion. This also means small cap companies might be highly leveraged. They may have borrowed a lot more money. They might have issued more bonds. Bonds are not Sharia compliant. They're completely interest based. They give you return based on interest, riba. So we don't even invest them. We use sukuks. The sukuks are Islamic bonds. They have a profit and loss sharing arrangement. Mid-cap companies are usually those that are between the 2 billion and about $10 billion mark. These are also great for growth stocks, because the mid-cap companies may not pay you a dividend, but your hope is over time their share price will increase, and that's how I'm going to profit from them. Large cap falls into the category of 10 billion or more in market value. These companies are really stable. Their stock price doesn't really fluctuate that much. Chances are some of them will also give you a dividend income. So that way, at least even if the share price goes down, surprisingly, the number of shares you might hold may go up, because that's perhaps how the dividends come in. So those are the things to keep in mind. So anytime You're looking at a company, maybe you're someone that likes to trade on your own, understand which category it fits in, what's its market cap. Based on that, you can gauge and see how much debt they have, will it fit the Sharia compliant guidelines or not, and is it even worthy of a good investment or not. The way I always tell people, trading is short term, investing is long term. Long term meaning 3 years plus, 5 years plus. Keeping that goal in mind is what you should focus on when you're investing, ideally. So that way, again, that fear of losing everything is not there because you already know the goals that you've set up for yourself. So let's talk about now the type of funds. So like people like to ask, okay, what kind of funds can I invest in? You have usually two types that are really popular: ETFs, exchange traded funds, and mutual funds. ETFs basically work like an individual stock. However, the funny thing is ETFs, imagine a basket of tons of stocks in them that have been given one value, and that value reciprocates to all the stocks in that basket. So through one value, you're owning, say, 200 stocks, for instance. That's your diversification there, and that's what the ETF is doing for you. Especially if you read the first paragraph, index funds are usually the ideal way to invest. Why? It's giving you a piece of the market without picking and choosing what to invest in. And that's the best part of index investing. You're mimicking an entire index, no magic involved. Whatever the index is doing, technically is what you will get as well. So ETFs are great because they have no minimum to invest in. You can buy as little as one share or sometimes fractional shares now as well. They potentially could pay you a dividend income as well. And they trade like stocks. You buy today, you can sell it tomorrow if you want to, or a week later. Mutual funds are different. Mutual fund, and by the way, this term is also known as passive investing. Passively managed funds are index funds. Mutual funds are usually actively managed, meaning there's a portfolio manager sitting behind the scenes saying that, you know what, we're going to take the S&P 500 and pick the best 40 or 50 stocks from there. And we're going to put them in a basket. We'll name that basket mutual funds. Now, here's the difference. Lack of transparency exists in mutual funds. If you guys look online, there's a website, I'll tell you, morningstar.com. If you haven't heard of it, use it. They're actually based out of Chicago. It's basically an independent website that gives you reviews of different funds, all of them that are publicly available. And in mutual funds, you can only see 10 of their top holdings. You don't see anything else. Publicly traded ETFs that are index ETFs, you can actually see every single stock they hold. So they're more transparent. So coming back to actively managed mutual funds, what they say, the portfolio manager will say is, we'll select the best 40, 50 stocks. That's usually the limit of most stocks in an actively managed mutual funds, and we'll trade them. We'll buy and sell them every month, every quarter if we have to try and match the performance of an index. Now, historically, mutual funds that are actively managed have not been successful in outperforming index funds that are tracking an index, basically. Number one, they're more expensive because there's a portfolio manager behind the scenes who needs to earn his or her income as well, and there are other managerial fees with it. Passive index funds, yes, they have a portfolio manager, but he's not actively buying and selling. He's mimicking an index, or she. And that's why the fee can be lower, because remember, your fee matters. Anytime you're investing, doesn't matter if you're young or old, just like your gains and growth, fee will compound. It will grow over time. Even if you're paying someone 1% a year, hey, I'm only paying 1%, doesn't seem like a lot. In 10 years, you've paid someone 10%, which could have been your potential gains, compared to 0.5% maybe. That's just 5% that you've paid in 10 years compared to 10%. So value does matter in terms of not just what you're investing in, but how much it's costing you as well. Because of the competitive nature of the investment industry now, you can really find Sharia compliant index funds. Wide has one of them, like I said, Halal HLAL charges 0.5 basis points, 0.50%, for instance, a year. And Alhamdulillah has done pretty well as well. But I'm not supposed to talk about performance during this webinar, so you guys can look it up online and be pleasantly surprised. So that's basically a division of active versus passive, ETF versus mutual funds. It's important to know that. But index investing is a smart strategy. Jack Bogle, the founder of Vanguard, believed in it. That's what he created Vanguard based on. And even my firm that I work for, when we were deciding to launch funds, the idea was, yes, you can create a mutual fund tomorrow, but why not do something that's more unique and follow a methodology that will provide more success and diversification, which is an ETF. That gives you more stocks as well. So if some go down, some are going up, you have your risk managed that way. So, and because I've already mentioned this, I just realized I had this slide. The difference between index funds and mutual funds that are actively managed, this visual should tell you just that. Index funds, everything within that index is being mimicked, put in a basket. Here you go, enjoy. Active, Let's choose some of the best performing ones. Let's play with them and make sure we can hopefully give some returns. By the way, in the short run, 2-3 years, actively managed funds can do pretty well to limit losses. But over the long run, as I said before, historically data has proven that index funds do outperform. So let's talk now about the type of investment accounts available out there. I don't know the demographic of you guys right now. I don't know if you guys are in college, have you just started working, or you are already in mid-career or somewhere. Retirement accounts is probably one of the two most investable product in the US. Either people invest in retirement accounts or they invest in real estate. That's just how it works. There are different types of retirement accounts, and this screen from the top left to the right is what I'll follow. 401k, these are just letters and initial. That is for the IRS to define what kind of a retirement account you're investing in. 401k, 403b, 457b, just to show if you work for corporate America or nonprofit or a hospital or a school or university. Doesn't mean anything beyond that. It doesn't mean that that name will define if it's halal or not. Sometimes people ask me, is a 401k halal? That's just the name of an account. What's halal or not, or permissible or not, as I like to say it, is what's going inside that fund. What kind of investments are you doing? Are you buying individual stocks? Are you buying mutual funds or ETFs? What type are they? Every year, what you can invest in them in terms of dollar value can change based on IRS guidelines. And you guys can look this up on IRS website as well, irs.gov, even though I know we want to stay away from the IRS and not go and see what's on their website, but they have some really cool information about how much you can contribute in retirement accounts based on your income. So, and always have a tax consultant in mind to work with when you guys are doing this, especially now, April 15th is the tax deadline. So you want to make sure you are taking advantage of these tax deferred accounts. So that's what 401ks do. For the year, the limit is 19,500. That's the maximum you can contribute. Chances are your employer may or may not offer you a match as well. The way to keep them Sharia compliant, if you are wondering, is one of two ways. Either your company may directly offer Sharia compliant funds in the suite, as I call it, the list of funds that have been predetermined and pre-established for your 401k, 403b or 457b, or you can ask for what's called a broker link or brokerage link, self-directed brokerage link, which basically means with your retirement account, you open a sub account, you move money from the retirement into the sub, and from that you can buy almost any fund that's publicly available. I've given talks at Google, for Intel, recently for PayPal, where they have a Charles Schwab retirement account and they have brokerage link by default available. So it's something you can ask your HR or ask them, who is the financial advisor for my retirement plan? I'd like to speak with him or her, and then ask them, hey, do you guys have brokerage link option available? Sometimes if you log in your account, you may be able to find out if you have it or not. So that's that. IRAs, probably one of the the most misunderstood and least known accounts out there. What does IRA stands for? Individual retirement account. Why is it different from 401ks? Because you as an individual gets to set it up under your name, which gives you the flexibility to invest in anything you want. At any brokerage firm, you can open them. They have a limit though. There are three types, actually two types of IRAs, traditional IRA and Roth IRA. Traditional and Roth both have the same limit. If you're under the age of 50, you can only contribute $6,000 in 1 year. And the year is not from January to December, but it can be up until the tax deadline. So for last year, you can actually contribute up until April 15th into your traditional IRA. Traditional IRA works like a retirement account. And follow me here. What's the benefit of having a retirement account from your employer? You are getting it tax deferred. When you put money in it that your employer deducts from your paycheck consistently that you're investing, that money is not being taxed. It will be taxed after 59.5 when you decide to withdraw money. At that point, you may be in a lower tax bracket if you've retired. Same thing with traditional IRA, but there's a catch. It's income-based. Up to a certain income, you can get tax credits for the money you put inside the traditional IRA when you're filing your taxes. That makes it tax deferred. So at retirement age, after 59.5, when you take money out of a traditional IRA, you pay taxes on the entire amount. Now, Roth IRA is unique. Same limit, $6,000 if you're under the age of 50. Anyone who's 50 and up, it's $7,000 max for the year. Roth IRA says, well, we have income limits for you as well, perhaps not as much as traditional, but your gains are going to be completely tax-free. Why? Because by definition, in a Roth IRA, and that's just the account type, the money you put in is already assumed that it's after-tax dollars. The money you've received from your paycheck that's in your pocket, you've already technically paid taxes on it. So Roth IRA is after tax dollars. A lot of young professionals that are starting their careers, as long as you have earned income, I always tell them, try to go for a Roth IRA if your income allows. Your gains are going to be completely tax-free at retirement. There's a 5-year rule, by the way. If you have the Roth IRA for at least 5 years and you're close to, and you reach 59 and a half, you can take out your gains without penalties. Otherwise, if you start a Roth IRA, you can potentially take out your principal without any penalties and taxes. So you can do that as well. But your gains you don't want to touch, otherwise you'll pay penalties and taxes on them. Wait till 59 and a half. 403b, just like 401k. I marked HSA here. These are like sort of for people that are high income earners that want to find other accounts to save in. This is basically, think of it as an expense account for medical purposes. This is basically giving you money to put in that you can use for medical expenses, and you get a tax break on that money, basically. And then taxable account. What do I mean by that? Brokerage accounts, like individual investment accounts, those are taxable accounts. You have two kinds of taxes in them, short-term and long-term capital gains. Short-term is under 12 months. 12 months and up, if you have an investment for that long, it becomes long-term capital gains tax, and the rate for them is different. You can achieve tax in two ways. We discussed this earlier, growth and dividends. When you receive dividends, that's like an income you've received that will be taxable in that year. Growth is taxable when you take that money out and collect it. If you leave it in the account, you're fine. But again, I'm not a tax specialist, even though I've studied it. I don't give tax advice, so do talk to a CPA or tax consultant about understanding capital gains tax, depending on your income and how much you're investing. So be kind of in the know about that. Last but not least, before I go to one final thing, and then we can open up for Q&A, I wanted to throw in an idea about budgeting. It's something that sometimes people, either you're really good at it or you're pretty poor at it, weirdly enough. There's no hard and fast rule about how you should budget your expenses and how much you should save. This is just a guideline. The 50-30-20 rule is based on our needs, our wants, and then saving and investments. Our needs are something that we require, and it's a must. Your home, roof above your head, having transportation, being able to eat food so you can stay alive, medical expenses, and so on. These are your needs. Ideally, the way people look at it, they say, okay, 50% of my take-home pay will go towards my needs. This includes my rent or mortgage as well. 30% remaining out of that other 50, I'm going to put towards my wants. Like, I would want to go to Bora Bora on holiday or somewhere fancy, even though due to COVID, we know we can't go anywhere, and we're all frustrated with that. And people still post on their Instagram about the wonderful vacations they've been on and what they're missing out on life for this year. But inshallah, we'll all get there. But that 30% is related to your wants. I want to go in a restaurant and have a nice steak meal, probably a halal one. I used to live in Chicago, weirdly enough, so I used to go all the time to Devon, basically, to eat food. And I'm not going to say names of any restaurants just to promote them, but the pizza spot, let's say it, Tahura and all that, like good spots. I'd spent 5 years living in Chicago. That city is my home away from home and always will be. So anyway, all the things that you want to treat yourself for are your wants. And then 20% is towards saving and investing. Big difference. If you're saving money in your savings account, that is for a rainy day only. Rest of it, and you decide. There's no rule here. 3 months, 6 months, 8 months of savings, whatever have you. Due to COVID, what we've learned is that there's no exact guidelines to how much you should be able to save. Any amount that you're comfortable with that covers your monthly expenses for a certain period of time, that's your savings, not to be touched. Rest, let it work for you. That's what investments are for. That's why the stock market is there, is to help you earn extra beyond your basic income that you earn. And if it's done the right way, it actually benefits. We've already discussed that. So this, I want to give you guys a quick breakdown about the 50-30-20 rule. So keep it in mind next time you're doing your budgeting, and look at your budget on a bi-weekly basis. Every 2 weeks, just see how much money is coming in, what are your expenses, fixed and variable, and how you can manage to be more smart with them, where you can cut costs to save more so you can invest more to create residual income for yourself over time. It's all about the power of compound growth and compound return, time again. That's why we always say that it's the patient that usually gets paid off by investing in the stock market, but you can't also be too aggressive. You have to be a smart investor based on your age and time horizon as well. A 60-year-old investing 80% of the money in stocks is asking for trouble. If the market goes through what's called a correction or a downward trend, they risk losing more. Why? Because they don't have enough time to wait for it to recoup. Whereas a 25-year-old can say, yeah, man, I've got 30 years. I'm good right now. I can be as aggressive as I want for the time being. Again, depends on your goals and why you're investing. So last but not least, a lot of times people ask me, what's the best strategy to invest? How much should I invest and how can I invest? Can I invest lump sum and just let it work? Or should I do bit by bit by bit? So I always say DCA, dollar cost average, is the ideal way. And where do you apply this in real life? It's in your retirement account. Bi-weekly, there's money being deducted from your payroll that goes into your retirement account. That's dollar cost average. It's consistently being invested. And how does it work? So let's run a quick example, and then we'll go to Q&A, guys. Say there are two investors, A and B. Investor A decides, I'm going to invest $40,000 lump sum on January 1st in a stock that's currently trading at $50 per share. Investor B says, you know what? Great idea, good for you. I'm also going to invest $40,000, but I'm going to divvy it up over 12 months at a rate of $10,000 basically, on a quarterly basis. So every 3 months, I'm going to drop $10,000 in the market, but I'm going to invest again in the same index fund. They're both investing in an index fund. So there won't be any surprises in terms of performance. It's going to be the same for both of them, but they're both investing the same amount in different ways. One is put lump sum, investor A. Investor B says, I'm going to divvy it up starting same January 1st for $50 per share, but I'm only going to put 10,000. And then every 3 months, I'm going to keep adding till I hit 40,000. So what will be our scenario here? When you invest lump sum for $40,000, our investor A bought 800 shares, line one. Line two, the end price at the end of the year was about $35 per share. The market value that he or she had invested was about $28,000. So you started at 50 bucks, end of the year, that same stock is trading at 35. It probably started there, went down, up again, down and up. Volatility is real. We just discussed that. So it's not a surprise that maybe for whatever reason, the share price is lower than it was when you first started. Any given other year, it might have been higher up. So this individual is actually down 30% on his or her investment because that person invested lump sum. Let's see what's happening with our friend investor B. Investor B, funnily enough, ended up acquiring more shares compared to our friend investor A. Why? Because of dollar cost average. There were times in one quarter when the share price was probably below 50 bucks. So he or she managed to buy more shares for $10,000. Whereas in one of the quarters, it might have been above 50 bucks. So he or she purchased less shares, but for the same amount. That accumulated to actually more shares overall. That's the beauty of dollar cost average. End price is the same, 35 bucks. Market value for this person is $33,527. This person's loss is actually half close to of what investor A has incurred. So the market is down for both of them on this particular index fund as an example, but one is down 30% versus, again, the other one is down only 16.2%. So our friend investor B was able to mitigate his or her risk by diversifying their investments, not just A in an index fund, we know eventually they'll be fine, but also by divvying up their investments. So dollar cost average is an extremely powerful tool that can work in any environment, provided you have your goals set. Now, I'm not saying that this means you will always be making money. No, that'd be a lie. There is market risk that exists, and we discussed that before, but this strategy works over the long term. So as a young individual, young professional, 18 and older, you're able to set up a brokerage account tonight. Take advantage of dollar cost average. And there's no rule to how much you should start investing. When I work at Wide Invest, the minimum is $100 to start with. And like I said, if you want to buy an index fund, there is no limit. Start with whatever, if you're going to an independent brokerage firm that you're opening an account from. But be consistent, whether it's weekly, bi-weekly, monthly, bi-monthly, or quarterly. However you can regularly invest, force yourself to do that. It will tremendously help with creating the residual income bucket for yourself and stay diversified. I mentioned one thing earlier, core and satellite strategy. Your core strategy is one where you have a professional platform doing the work for you, where you invest in an index fund and let it work for you. Your satellite strategy is what we are seeing all around us, Robinhood and others. I feel like it's like a sin word nowadays, Robinhood to even say. But there you can say, okay, I'm going to dabble in the market on my own. I'm willing to risk this money 100%, because that can happen. If you're buying 3 or 5 stocks, they can all go up, they can all go down to zero potentially. When you're in an index fund, you might have 150, 200 stocks. Logically, it doesn't make sense. Why would they all go down to zero? Because then that would mean that the US economy ceased to exist. I've always made this statement and I'll continue to make it. So index funds have somewhat more of a sustainability rate compared to just investing in individual stocks. So keep those strategies in mind. I hope the understanding was good here. Based on that, I want to wrap up quickly with a few key takeaways here, that as Muslims, the more we invest, the bigger voice we have, the more representation firms like mine can make in the future on behalf of our clients through shareholder advocacy and impact investing, asking companies to change some of their mandate because we have shareholders in them. And it does work. Index funds are a great strategy. They track indices like the FTSE Russell Sharia, which is the Sharia compliant index fund, or others that are ethical or socially responsible because it's diversifying your investments. Don't let your emotions dictate your investment goals. Don't just decide that, oh, today I've invested, in a week I'm going to freak out because I can see the market is going down. You will make an irrational decision, whether you like it or you don't. It won't be a smart decision. 16 years of experience has taught me at least that much for sure, to be confident about. So keep emotions to one side like a plate of cold potatoes, but focus on the goals at mind and that you're looking out for. Consistency is key. Take advantage of dollar cost average strategy. Give it a try. This year, my goal primarily is that I want as many people as I can to start doing dollar cost average for one flat year and see where you stand at the end of the year. There's still time. Get started. Align your goals with your investments. Sometimes people tend to forget that, why are you investing your money and what for? So based on your goals, you can invest accordingly, knowing if you want to be short-term, medium-term, or long-term investor, based on why you're investing and what you want to achieve out of it. As I mentioned before, know the difference between your core and satellite strategy. Having a professional platform through an index strategy or trading on your own. Two different ways of doing it, as I discussed earlier. So with that, I'm pretty much done. If need be, guys, Raheem, Hamzah, I can keep this screen on as the key takeaways while we do Q&A, or do you guys want me to close the screen? Up to you guys.
We can keep it on for a bit and then maybe turn it off after a few minutes. Just if you're on the YouTube side, feel free to keep the questions coming. Hamzah will be monitoring those and giving them to us. But we have a few questions right now, which we can start addressing.
Yeah, please.
The first question is, do you see the concept of halal investing going more mainstream in the near future?
Oh my God, absolutely. I think it's just a matter of time. There's still a lot of work to be done from an educational standpoint on that, and I'm a firm believer of that. I've spent the last few years doing multiple workshops. Last year, I did probably the most because of the whole virtual lifestyle that we're living. Financial literacy is key to make Sharia compliant or halal investing mainstream. And inshallah, I can see that happening in the long run. It's still very new for people here to understand, but I think the potential is immense. That's why companies like the ones I work for exist solely for this purpose as well. But I can definitely see that happening, inshallah.
Nice. And just to expand, if you can touch base, maybe how halal investing was 5 years ago or 10 years ago. I mean, just in the past.
Sure.
Compared to now.
The misconception, or actually the correct thinking was back then that, oh, if I invest my money in line with my values, I will not make the same returns as the market itself. And when I say market, I'm talking about indexes like the S&P 500 and others. S&P 500 is the go-to index. That was a misconception people had for the longest time. And to some extent, they were right, because when you have actively managed mutual funds, it can go either way. And things were still new even 15, 20 years ago in America about Sharia compliant investments. Now, thanks to the birth of index funds, that fear has been taken away. Whatever returns the broader market is giving, similar returns you can get while staying in line with your Sharia compliant guidelines, or ethical guidelines, as I like to say it. So being ethical does not mean you're going to give up on returns. It's actually quite comparable to the broader market. And that's one big difference we've seen over the years. Plus, with growth of other firms that actually specialize in this space, is giving us more opportunities as well, more flexibility to invest in. And again, diversify. More opportunities you're spreading out of your investments, the better you are off. So those are the benefits I've seen over time that have come through, where we were 5 or 7 put it this way, guys. 6 years ago, I did not know much about Sharia compliant investments. I looked for it. I researched it because I was like, based in line with my values, why can't I work with my people, helping them invest in the best way possible based on our guidelines? There were times when initially I'd started my career in London and I didn't know what was in my pension account there. could have been a Budweiser stock or Heineken. I wasn't aware of it. Even though I was working in the investment space, funnily enough, that research had never crossed my mind. But as I educated myself, I realized this is far bigger than we think. We've got 2 billion Muslims, 1.6 billion Muslims around the world. Just imagine the power that we can have. I think we have about 5.8 to 6 million Muslims in America. You guys have a massive population in Chicago alone, for that matter, or in the state of Illinois. So just that power of group investing or community investing can make a massive difference as well.
Agreed. Hamzah, do you want to ask the next question?
Yeah, so we had a question come in and we talked about index funds. So the question was, most index funds contain non-Sharia compliant stocks. Are there any that are fully halal?
Yes, there are now. That wasn't the case before. However, I'll say one thing to add to that before I get into the answer. If you guys have a retirement account, if those of you who are working full-time right now, as I mentioned earlier, if your concern is whether your investment is Sharia compliant or not, ask them to get an investment policy statement or like a statement that will show which funds you have available and see which ones are probably blue chip stocks or technology-based stocks. Again, I'm not giving advice, but I'm giving a recommendation of how to do your research. They are still somewhat okay. Unless you can get brokerage link, then you can invest in, like my company launched Halal about close to 2 years ago. HLAL, that's an index fund. That's Sharia compliant. It tracks the index called FTSE, FTSE, Russell Sharia Index, for instance. That's been around for 10 years, and we just mimic it. So yes, you have a few more out there, but there are more Sharia compliance index available that give you a dividend income, and inshallah, that growth over time as well.
Great. One question that we had is, how does zakat come into play with halal investing?
Good question. It's just like any other thing. It's an asset, right? I mean, I don't do zakat calculations for clients, but there are many references to investments and calculating zakat on investments online. I'll say Sheikh Joe Bradford out of Houston, Texas, very well-known individual. He's written books on this stuff. So you guys can actually Google search. In fact, even some of the charitable organizations like Islamic Relief and others may actually have a investment calculator on their website, possibly to say how many shares you own, how long you've owned them for, what's the share price, to do that calculation on zakat. But it's due, because at the end of the day, it's your income that's growing. So anything where you're making money from becomes zakatable, basically.
Great. And for apps like Zoya or Islamically, to check the Sharia compliance of a stock, do you recommend those? How do you feel about those? And also, does Wahid plan on releasing something similar to talk about that?
A good question. I'll go backwards. We had something similar before, but we realized it was distracting the clients a lot from investing, if anything else. People were spending more time speculating stocks rather than actually getting involved. And we felt like it wasn't the best effort of our time. So I don't know, maybe in the future we might do it again. But we felt like at the time, 3 years ago, it wasn't ideal. Zoya app, I think, has improved a lot. I have seen it being used. I knew initially they had some issues with their calculations because they were not following AOV guidelines the right way. But again, I've got nothing negative about that. I think, again, it's another opportunity for our communities to know what they're investing in and having a third-party resource for it. I believe it's always important to do your due diligence. Make sure that the folks behind Zoya app know what they've done, who they've worked with, how they created this stuff. Those questions are important. But I think for those, again, this comes down to your satellite strategy right here. If you are investing in stocks on your own, be aware that you have to do your research on it, right? If time allows you to do it, great. Apps like Zoya serve the purpose for you. Fantastic. Keep at it. On the back end, still invest in opportunities like index funds that are Sharia compliant. So you have your assets locked in that are growing consistently, inshallah, and then doing your individual investing using resources like Zoya and others.
Perfect. We have a question about taxes. How do you file taxes with stocks?
You get statements. So whoever you trade with, whether it's Robinhood, whether it's any other platform or the company that I work for Wide Invest, usually by mid-February every year, they'll send you out a form called 1099. It can be 2-3 different types. 1099-R, usually related to retirement accounts, 1099-DIV, if you have dividend income and so on. And if you have actually made withdrawals from your account that includes your gains, you'll get the statement. The statement will tell you what you need to do and what you need to, I mean, it's all calculated for you, basically, your gains that you would have to input when filing your taxes. A lot of times you can actually link them to TurboTax and be able to import them if you use that platform. Or if you have a CPA or a tax consultant that you use, which is a really effective way, give them the statements, they'll throw in the numbers for you. But usually the gains that you're looking at, if you have not taken any money out, and again, you can confirm this with the tax specialist, the dividend income you've received, on that amount you'll pay taxes. Or if you've got the dividend income and you took money out, which includes your gains, you pay taxes on those gains as well. You never pay taxes on the money you've invested. So that's your after-tax dollars. So you invested $100, you receive $1 in dividend, you pay taxes on $1, not 101. So just keep that in mind.
Great. And what about options trading? Is that like a agreed upon halal thing or one or the other?
You know what, it's a tough one to answer because where I work, we don't dabble in options. There are mixed schools of thoughts about it. The general consensus is that because you don't have the ownership of a stock, potentially there's speculation involved in it, which is a complete no-no. That it's something to potentially, so it's a big gray area. So at the end of the day, Allah knows best. We're still as humans trying to find the best ways to invest based in line with our guidelines and what's permissible. So it's kind of a gray area. I personally, we kind of avoid it where I work. So I'll say that you might be better off speaking with a local scholar or someone that has knowledge of fiqh and finance to kind of get their input on it as well, or search online. But it's a big gray area. So a lot of times people tend to avoid it more often than less. But some justify by saying, well, it is actually permissible as well based on guidelines. So because it's 50-50, you get to be the best judge of it, honestly.
Got it. And can you just quickly explain, like, what is it?
You mean what an option is?
Yeah, option trading.
Okay, so in a simple nutshell, stock A is trading in the stock market. I don't want to buy it, but I want to guess if it will go up or down in value in the near future. So I'm going to call out loud, think about this way, call up that the price will go up. So I'll place a call option by saying, in the future, I believe this stock will be trading at this value potentially. Or you can say, I'm going to put down, I'm going to place a put option, guessing again, that this stock may go down in value by a certain timeline. So you're basically betting against, in favor of, or against that particular stock's value. And that's what options trading is.
Got it. Perfect.
Sorry.
Go ahead.
Do you have your next question, Raheem?
I was just going to mention that one brother was asking, like, if investments is a good place to hold all of their cash as opposed to a checking or savings account, and possibly if there's like some guideline on how much.
So I said this earlier as well. There's no guideline on how much to invest. It comes down to you. How much are you comfortable investing? For what purpose? Drawback of savings account is that they do incur interest. As long as you're able to keep a track of that and know that you're not going to use that interest money and find ways to avoid it, you're fine. It's always important to have some cash available, I always say, because for a rainy day, even though the best part about investing in the stock market is liquid. You invest today, you can withdraw tomorrow, more often than less. Same thing with the Wahid platform. You invest today in an individual account, you can take the money out whenever you want, no restrictions. Minimum is $100, set up a recurring deposit, let it work for you. So it really comes down to you, but there's no harm in having some money for a rainy day available in a savings account in case you need to dabble into it to use it. As opposed to taking money out of your actual investment account. Because that could be your more long-term play, basically. But there's no exact dollar value guideline. It honestly comes down to what are you comfortable doing with. And that's why Wahid Invest created a platform that's for everyone. You can be an 18-year-old that is working part-time, can invest a minimum $100 to clients that I work with, that mashallah have 7 figures with us. And the goal is, bottom line, that we want almost every Muslim to be able to invest their money in a Sharia compliant way without the fear of it. And that's why our platform was built for that particular purpose.
Perfect. And I have the question that everyone's been asking, with everything crazy going around us, what is the Sharia stance on stocks like GameStop and AMC, and if these pump stocks are considered gambling?
So a couple of things. To take a kind of backseat and look at the bigger picture, though, rather than letting your emotions get in the way, because I know last few days have been very emotional for people reading stuff on social media, Twitter, CNBC, the whole lot. So you can get wound up in that emotional bubble of it as well. In reality, what you have to look at is, okay, what are my beliefs in investing, first of all? Faith-oriented, Sharia-compliant, ethical. What does that mean? Things like speculation, not allowed. if you are literally playing a guessing game with a stock that you want the share price to go up, eventually that potentially does fall in the bracket of potentially you're gambling. It's like the same way, and forgive me if no one likes the example I'm about to give, but if you're playing on a roulette wheel, you have the dice, you make dua and you throw the dice on, hoping it will hit a number that you want. That's pure gambling. Sometimes this behavior can potentially create just that. So speculation is not allowed in Sharia compliant investment. It has to be very transparent. And to your point, to this question, do you guys are all familiar with the literal definition of what Sharia means? Raheem, Hamzah, what about you guys? The literal meaning of Sharia.
I'm not sure exactly.
Path to water, or path to an oasis. It's a route created to get to water, because water is transparent. It cleanses, it's life. And that's what Sharia compliance. A lot of times people get thrown off by the term Sharia when it's used a lot, because unfortunately it does have like a negative mindset in some ways, unfortunately. But in reality, it's all about creating guidelines that are transparent. So you need transparency. So whatever's recently has happened was an action taken for a particular purpose. One can justify it in one way, one the other, but definitely has some aspect of gambling mentality involved in it, because that's how it makes you think. So these stocks will potentially not pass the Sharia compliant guidelines, for one. And that's why our platform, the firm I work for, Wahid, does not dabble in individual stocks for you. These are predetermined funds, guidelines based on risk profiles that you choose, how aggressive, moderate, or conservative you want to be, and it's invested based off that. You're doing something on your own, of course, that's completely different. But in line of what we've seen, number one, we don't even follow Wall Street bets. We don't sort of rely on their insights. Our own analysts do the work in-house. Our portfolio manager used to work at Google, mashallah. He spent time at JP Morgan. It's a very knowledgeable person that manages the portfolios for Wahid and our ETF as well. So in line of recent events, yes, speculation is there. That makes it a no-no in many ways.
Makes sense. And one question that we have is, a brother's asking is, what does it mean when people use the term compounding interest? And is that referring to riba?
Great question. And I was hoping someone would ask it. So no, it does not. Even though the term interest is used, but it has nothing to do with riba. Bonds are 100% riba based. But compound interest is literally a term used for your money to grow over time. If you invest $100 today, a year in, you gain $10. Your compound growth or compound interest is $10. 5 years later, it doubles. So your compound interest now is an extra $100. So literally the term compound interest is your interest of an investment that is growing over time, so that your capital that you've invested is just sitting there, and the rest of the work is being done by the gains that you've generated in your account. That's what compound interest pretty much is. It has no direct correlation or relation to interest itself or to riba. It's just a term used for growth in your money that is being invested over a period of time.
Perfect. We have a question about crypto. There's a lot of
sure,
demand
yeah, I get them
about
often.
that.
Yeah.
So thoughts on crypto and any plans for it to be in a halal fund, or, I mean, is it even halal, right? That's a question that some people are asking.
I mean, all the white papers that I've read, definitely a lot of scholars have been looking into it. Some of the scholars on my firm's board are independently looking into it as well. And they have their own comments about the validity of it being Sharia compliant and so on. From an investment advisor point of view, because I'm a licensed advisor, I have to be fiduciary. Our platform has to be fiduciary for clients. Problem with cryptos is the biggest issue is this volatility. No matter however you try to justify it, that, hey, it's based on volume, or it's based on the fact that there are limited Bitcoins available that eventually will run out of, mining and so on and so forth. None of that matters. If I'm going to offer cryptos to my clients, I have to be fiduciary, meaning their interest has to come first. With stocks or with index funds, risk can be mitigated. With cryptos, there's limited control, basically. So it could be 20,000 today, 50,000 tomorrow, 5,000 the day after. So because of that excessive volatility in it, it's not something personally I'm in a position to offer, nor is it something that my firm has considered for now, basically. In the future, you never know. You never know. But because of its extreme volatility, it's very hard to make it an advice-based product to offer, basically. But from a lot of scholars I've read, they found validity as to why it is Sharia compliant as well. And you guys can find that stuff online. Actually, just search do cryptocurrencies happen to be Sharia compliant? Maybe not all of them, but perhaps some of them, depending on their structure and so on.
Got it. And one brother was asking a question, what's your opinion on transferring everything from a traditional IRA to a Roth IRA? And also, I guess this can go vice versa, right?
No, it cannot.
I
So a
see.
Roth cannot go to a traditional. It was able to. Sorry, man, I said it too directly. It's force of habit. Thanks to Mr. Donald Trump, he kind of changed some of the rules there where you can convert a traditional IRA to a Roth, but you can't go backwards. So why would you do that? Last year it was ideal to do because of the CARES Act and some of the sort of rules and guidelines placed in. There were not going to be certain taxes charged for people. And I'm kind of forgetting all the details of it right now. I haven't looked at it in a while. But the only time you want to convert a traditional IRA to a Roth is because you want your gains to grow tax-free. That's what we know about a Roth. However, whatever amount you have in a traditional, when you convert it to a Roth, you will pay taxes on that amount, a one time on the conversion. So speak to a tax consultant and find out, based on your income, the tax bracket you fall in, is it worth it for you to convert it now or not? I've had clients that have actually done that. I know people that have done that of small and substantial amounts. And because they just wanted to, they said, you know what, I'd rather pay taxes now because 15, 20 years later, I would have potentially earned that money back, as well as all my gains would be tax-free. So it's not something that you cannot do. Yes, you can. You need to figure out, are you okay dealing with that tax burden or one-time tax burden of converting from a traditional to a Roth? Once you've done that, you cannot go backwards. And to that, the one thing I'll add is you can actually contribute to both of them. Depending on your income, you can actually contribute to a traditional and a Roth. Like we said, the max is 6,000 under the age of 50, but that doesn't mean there's 6,000 in each of them. It's total. So if you have a traditional IRA and a Roth and your income allows you to open both, you can't go above, let's say, 3,000 in each or 2,000 in one, 4,000 in the other. Seeking tax advice on this is really beneficial. IRAs are a great source of tax deferred investments, so you're not paying money to Uncle Sam right now. So do your homework on that. At my firm, Wahid Invest, we offer traditional IRA, Roth, and even SIP IRA, which I actually did not touch base on. If you are a consultant and you want to open a retirement account, you can open a SIP IRA as well. That's what it's called.
Perfect. We have a question about, is Wahid seeing an increase in number of non-Muslim customers who value the ethical concept behind halal investing?
Funny question. I actually recently had a conversation with someone out of Michigan. No, sorry, tell a lie, Minneapolis, who was referred by his Muslim colleague about Wahid, non-Muslim person. But he said that the reason I'm investing is because I like the idea of investing in line with true Christian values about not, eating alcohol or hurting animals and so on and so forth. So we have definitely seen an interest. Unfortunately, it's still low, maybe about 5 to 8 clients out of, several thousand that we have are investing with us, but the interest is becoming there. And also because of financial literacy workshops and stuff I'm doing, I want that to become a thing where people of other faiths can actually invest through Wahid, again, giving us all a voice on the impact level stage, but also knowing that, in line with my personal values, this works. So great question, Hamzah. And yes, it is something I have seen come up. I'm having conversations with people about it. Even at some point, we can see working with churches and synagogues and helping them manage their assets, inshallah, maybe in the future as well. So it's definitely something that's more building an interest now.
Got it. And one question a brother's asking, if you can just clarify and explain. So his understanding is that you're basically hoping for the investment to go up, and because you're hoping, speculating, it may be considered like gambling, and how is that halal?
So gambling is like, imagine throwing a dart in the dark and hoping it will stick somewhere. When you're truly investing in the stock market, rather than playing the game of, hey, I'll invest this morning and I'll play a guessing game and take my money out in the afternoon if it does well. Speculation, that's gambling. But if you are doing a strategic investment where your hope is, look, the biggest difference is there's a risk of losing money. That's what makes the Sharia compliant as well. There's no guarantee you're always going to make money. But the gambling concept is quick in and out, whereas long-term investment is, I'm going to invest my money in a fund that's an index fund, is Sharia compliant, and I'm going to give it time to grow. That is patience already there. While at the same time, you have the knowledge and understanding that market risk exists, which is what we discussed before. So I know the volatility is there, the risk of potentially losing some, as opposed to also gaining some is there. But we know that the market rewards the patient. We've seen that historically during the Dow Jones chart. So it eliminates the question of the whole gambling part. Yes, some people bring it up and say, we think investing in the stock market is gambling, each to his or her own in reality. We work with scholars. I've worked closely with people like Sheikh Yasir Qadhi and various others as well, including our board, to have a better understanding of it. So because it's a long-term strategy, also, there's a risk of losing money. It takes that aspect of gambling out of it then.
Makes sense. And one brother was asking, can you invest in index funds or ETFs that are above the 5% non-Sharia rule and then purify it? And also just the concept of purifying.
So concept of purification exists because sometimes you don't know what a company is going to do. Screening on a Sharia compliant fund is done on a monthly basis on every single stock, but quarterly, the stocks are replaced if they completely fail all the guidelines. Rarely that happens. That's the beauty of Sharia compliant stuff, that we're not replacing 10 stocks every quarter. It might be like 2 stocks a year, 3 maybe at most. I'm giving out random examples. Sometimes, and it is kind of a tough one. If you're investing on your own, you can do a math based on your best assumption of like a 5% understanding that, okay, this much, I'm just going to donate to charity. It's not sadaqah, it's not zakat, just to be clear. Pure charity, to remove it from my investments. So at least Allah knows best that I'm trying to keep my portfolio cleansed. Someone who's investing through Wahid doesn't even need to think about it, because you get a purification report from us. And that tells you how much money out of pocket. You don't even need to take it out of your investment account, out of pocket to donate to charity. So I have clients who do that on their own, and they're like, okay, we know there's a 5% threshold. I can kind of base it off that and maybe just donate out of my pocket, basically. So that's something that people do just to make sure that their conscience is clear in that sense. But you cannot control the 5% threshold, because you don't know which company using a massive portion of their revenue is investing in other businesses. Not unless you're scrubbing through the balance sheets on a regular basis, the 10Ks and so on and so forth by the end of the year and so on. So an assumption is still safer than nothing. But again, if you have more questions about it, on the Wise Journal section, there's some information, and you can always speak to a local scholar as well and pick their brain on it.
Right. One brother was asking a question. Does DCA just protect you if the price lowers, or does it also help you earn more if it increases? So just more advanced, like, understanding of it.
So on a high level, the purpose of DCA is to help absorb volatility for you. It can't eliminate it. What do I mean by that? To your question, if you're investing $100 every month consistently in a fund, the fund price, when it goes down, benefits you. Why? Because for $100, you're buying more shares. Why? Because it's cheap now. It's at a discount. When it goes up, you're not overpaying for it too much. You're buying less share for that price. So your average number of shares that you own over, let's say, 1 year increases because of that up and down. So what it's doing is absorbing that volatility pressure and giving you more of an option. So what could happen is, at the end of the year, like we used in our example, the share price might be down, but you might be up in your number of shares because of that, and you might be receiving dividend income that increases also the number of shares you have. So its pure purpose is to absorb volatility because it exists. It happens year after year after year. It's not going anywhere. So it's all about use DCA to mitigate that pretty much.
Great. Someone was asking, what are some Sharia scholars that you can go to, or that for financial guidance?
Oh God, there are a few out there now, mashallah. I know Sheikh Joe Brackford is one of them, who's based out of Texas. He's pretty vocal. He's active on Twitter as well. There is Sheikh Taha Abdul Basir. I've had the pleasure of working with him in the past as well. He's based out of New York. You can look them up online. We've worked with Sheikh Yasir Qadhi, but he was more like not a Sharia advisor, but an ethical one who wanted to provide educational content. I know Sheikh Umar Suleiman is one of them. And there's one in Michigan that I'm forgetting the name right now. And if it comes to me, I'll mention it, because I've worked with him and it's embarrassing that I'm forgetting his name. But there are several out there now. You can literally just search Sharia scholars, United States, and see what comes up. You want to make sure that they have the right credentials as well. They have a Sharia auditor certification education, ideally, maybe, and they've been to good universities where they've studied fiqh in the right way, and they know about finance and economics to get the right merger of like knowledge there.
Makes sense.
And even local, I mean, sometimes even in our local communities, even in Chicago, there are a few, I'm pretty sure, that are, mashallah, reasonably well known as well, within the Sharia compliance space that know this stuff. So you can literally search by state.
Yep.
Hamzah Maqbool. Hamzah Maqbool is one of them. Sorry, he's in Chicago. I've worked with him before as well, Sheikh Hamzah Maqbool.
Yeah, I know a few in Chicago. Mufti Abrar also
there you go.
is in finance too. So I think looking locally is also really good.
It is ideal because then you have someone to potentially go to and get some of your more in-depth questions answered.
Someone mentioned that you mentioned tax deferment in one part, and they're asking, is a TDA haram? So I think that's a tax deferred annuity, right?
So annuities are questionable because they're insurance products. They're guaranteeing you a return as well. I don't offer annuities. We don't. They do have a big question mark. Sometimes the returns are interest originated as well. So absolutely, there are those gray areas there about annuities in general. Plus, they lock you in. Annuities have like pretty high fees if you want to break out from them earlier rather than later and so on. So it's definitely a big question mark on annuities. We know that there could be potentially interest-based as well, so that would make them haram also. The whole purpose of tax defer is to say, find smart accounts like traditional IRA, 401ks or SEP IRA, where you put money in based on your income. When you file your taxes, you get a tax break or tax credit against what you have deposited in there, in that particular account, so that that money grows over time. And when you retire, your hope is you'll be in a lower tax bracket. Although, just like inflation that will grow over time, the tax rate we are in today, 30 years later, it's highly probable we will not be. Could be slightly higher. That's why you're also investing your money. If it's just sitting in cash, it's not doing you any favors. It's losing its value, purchasing power over time. The only money you're sitting in cash on is your rainy day money. Doesn't matter what that happens to it. But the rest of it, you want it to be working for you. So, so retirement accounts, traditional IRA, even Roth, where gains are tax-free, are smart investments to make. These are, again, account types. What you invest in them is what matters.
Makes sense. So someone was asking, this is pretty specific, but we see companies like Nike that are rumored to have horrible working conditions, maybe even child labor. And are things like this researched when determining Sharia compliance and when it gets in the fund?
Sure. Great question, actually. A lot of people ask this. So let me clarify. There's something I mentioned earlier, impact investing, shareholder advocacy. There are many terminologies out there now that were new 5 years ago that have become common. ESG, economic, social governance, impact investing, SRI, socially responsible investing. That's my specialty. I've worked in that space. I've given talks at conferences on SRI space as well, and why it marries well with Sharia compliant guidelines. Sharia compliant guidelines have nothing to do with human rights. Technically, purpose of Sharia compliant guidelines is to establish the core business. What does it do? It's like saying, Suleiman Hani, that's the name. He's in Michigan. Great scholar. I've worked with him. It was bothering me. I couldn't remember his name. He said something really profound once at a talk I was with him at. If you're driving a car and if you have an accident and you hurt someone, does that makes the car haram or not, or evil? It cannot. Car is not a living being, but the action of that person is evil if it was intentional. But just because you're driving the car, it's a vehicle that you're using, that having an impact has nothing to do with it. Same thing when you're investing, what some of those companies are doing from an action of social responsibility is different from Sharia compliant. That falls in the space of economic social governance or impact investing. Now, Sharia compliant guidelines will not look at it. They will look at the core line of the business, financial ratios done. Beyond that, something I started this talk with, the voice. The more you invest, the bigger voice we have. So when they have the annual shareholder meetings, we can represent our clients, write them a letter and say, we disagree with what you are doing. You need to change your ways. May not happen today, may not happen tomorrow, but eventually it will. Chevron is one of them. Big oil company, gives great dividends. They have made tremendous changes to how they excavate oil and how they want to become more green energy focused simply because of shareholder advocacy. So you can take the route of ignoring things and say, I don't want to invest in this stock because they're not good to people that work for them. They have lots of human rights issues. Out of sight, out of mind. Doesn't mean they'll stop doing what they are. Whereas you say, I'm going to face you head on. I know your core business is fine, but we disagree with some of the things you're doing. Let's find a way to sort of change that and change that narrative, basically. Give me 1 second. Let me just find my charger. I just realized my laptop is running low on battery. So that becomes important. So to the point of that's where impact investing comes in. There's something which is really near and dear to me that I work on with sort of our compliance officers at my job as well, that we want to make sure more shareholders in the Halal ETF gives us a bigger voice in front of these companies. So that's the impact investing approach that I find quite powerful in that sense. Yes, in the future, as the company grows and we add new products, it's highly possible we may do that, where we might even create guidelines of how we can be socially responsible if we are creating baskets of individual stocks rather than funds, because we're mimicking a fund itself, an index fund. So following what they're doing, and our scholars work with them to make sure we meet eye to eye. But anything related to human rights, behavior of a company towards the employees or to the environment comes down to SRI and especially impact investing. But that in itself is becoming a really powerful tool.
Perfect. We have a question about the fan favorite stock, Tesla. A lot of people have invested in that, but recently we've noticed that they started selling tequila. So what are your thoughts on that stock, and is it Sharia compliant now?
So based on Sharia compliant guidelines that we follow, and remember I mentioned the 5% threshold, it's actually fine to invest in so far, simply because they're not generating enough revenue that will cross the 5% threshold of the overall revenue from tequila. So it's actually allowed. However, it's probably one of those stocks that we'll end up doing purification on. That's the best part. You're basically doubling up on something that's halal in a way by saying, okay, we know they're doing something questionable, but we know that we are aware of how much revenue they could potentially make or are making from it. If it's under the permissible guidelines established by AOFI, great. While at the same time, we want to make sure that we do purification on it as well, so we are able to cleanse that unintended income coming from that portion of the business, basically. So just because they're offering something that's haram doesn't make the whole business impermissible. That's one of the unique things about Sharia compliant guidelines, while at the same time, I'm sure it's something that raises eyebrows as well. But the reality is, A, you can't avoid interest completely, but you can find ways to reduce it. B, there are some companies that because you have those guidelines established, you know what they're doing with their revenue. You're able to track that. And in Tesla's case, we know it's a new business they've gotten into. They're not making that much money from it. We keep a close eye on it because Tesla is in the ETF as well, one of the major holdings. It's done quite well. Their core business is technology that we know. So it's not an issue at all from Sharia compliant guidelines, at least so far.
Perfect. We have a question about how can you tell the difference between a drop in the market or simply a bad investment?
That's a really good question. So drop in the market means wherever you are today, you're not there anymore. And it's not up, but it's slightly down. A correction is 10% drop in the overall value of the market. That's called a correction. Sorry, 20%, that's a correction. Bad investment is really based on what fundamentals did you follow when you were making that investment. Are you talking about an individual stock or are you talking about an index? Index cannot be a bad investment because you're investing in 200 plus stocks, for example. If you bought an individual stock, highly possible that that particular stock is either related to something extreme that's happened, which has reflected its performance, or you really just picked out a bad stock at the wrong time that's not doing you favors. So it really comes down to the strategy you have implemented more than just a drop in the market / a bad investment.
Great. And we have two last questions. We'll be finishing up soon since we're reaching almost 90 minutes now. The first question is, someone's asking, how does Halal, the Wahid fund, compare to other index funds such as the S&P 500 and VOO?
Okay, that's a great question. It's kind of like an apples to oranges comparison, though, because S&P 500 has alcohol stocks, weapons related stocks and others. So not an exact, but we have outperformed the S&P 500 by almost 10% last year. So it has done phenomenally well. If you go to the Wahid Invest website, there's a tab that says ETF. You can click on that and look at the fact sheet, or even better, go to morningstar.com, one word, and type in the ticker symbols, HLAL. It will give you from now up until inception, the performance basically. So compared to the S&P, the other one I'll have to look up, but we were quite pleased with the fact that alhamdulillah it's done pretty well overall since inception, in spite of going through the coronavirus pandemic as well. It has come out as a winner basically. So that, again, to one of my points I made earlier, by not giving up on your values, you're not giving up on the returns of the broader market either. But we did outperform the S&P last year. Doesn't mean it'll happen every year, but I'm happy that it did happen.
Great. And finally, the last question, if we don't have any more from Hamzah, is can you just clarify again the rollover from a 401k to a Roth IRA for someone who has a 401k with a company?
Okay, so two things. If you are currently working somewhere, you can't move that money away unless there's a unique clause in their disclosures that will allow you to move a retirement money while you're working. Usually, you move money, and the term rollover is used because you're rolling it over literally from an old employment, a previous job that you have left, because that 401k is just rotting away. You can't do much with it. To move it, the ideal way to do that is that you move it into a traditional IRA. Why? Because that works the same way as a 401k, same benefits, after tax dollars. If you move a 401k to a Roth, it's a taxable conversion because Roth gains are completely tax-free. Traditional IRA, whatever money you take out in retirement, you're going to pay taxes on the entire amount. So we, at my firm, we do that almost every single day. It's very easy to do. I have a whole team dedicated just for this purpose as well. They can actually help you guys with it if need be. They can do hand-holding and help you out with the process. It's pretty simple. But the process is you basically want to liquidate, sell everything in your 401k, tell them which custodian the new banker will go to with your new account number for your traditional IRA, and they'll basically just send a check or do a wire transfer of that amount into the new funds that you've selected to invest in. That's how a rollover works. But remember, it's from a 401k, 403b, 457b to a traditional IRA that has no penalties, no taxes, and nothing of that sort. You're not paying any penalties for moving money from one bank to another, custodian to custodian. You would pay penalties if at a younger age you took all your money out and kept it in your pocket, unless there are exceptional cases. IRS website covers these, like buying your first time home, you up to a limited amount you can borrow from your 401k or take out from your traditional. I believe traditional IRA is $10,000 as a limit, or medical expenses, so college education that will limit your tax burden and zero penalties on it. But the conversion from a retirement account by your employer goes into a traditional IRA for no tax penalties if you move it to a Roth, because your income allows you to open a Roth, and we know the Roth gains are tax-free. That conversion on that amount, you will pay taxes the next time you file your taxes. So speak to a CPA about that.
Awesome. And so that concludes all of the questions, but I personally had a question, if you don't mind me asking, would be,
Please.
what, like for future talking, like what accounts or types of accounts are there that you can make for like a child's education, and like are they halal or?
Great. So again, always remember, guys, when you're talking about a type of account, there's nothing halal or haram about it at all whatsoever. It's just an account. It's permissible. What's questionable, halal or haram, is the investment inside the account. So a traditional IRA, SEP IRA, Roth, 401ks, college custodial accounts, that's what they call for kids. Those terminologies are just to define the type of account it is. Nothing wrong with that. Everything will be wrong with what are you investing in those accounts, whether you're investing in index funds, individual stocks, are they Sharia compliant or not? That's what will matter. So there are different type of when I say custodial, I'm talking about accounts for kids. Roth custodial is one of them that you can open for kids as well. Schwab, Fidelity offers them. My firm doesn't right now, any college education accounts, but it's something we're working on. Or UGMA or UTMA, Uniform Gift for Minors Act or Uniform Trust for Minors Act. These are taxable accounts. After the first $1,050 in gains, everything above that, you actually pay taxes. First at the kids level, then the parents level. And that can go towards any purpose for your child, whether it's school, college, buying them a car, paying for wedding, whatnot. Then there is one called Coverdell. Depending on your income, you may be allowed to open a Custodial and you may not be. Again, Investopedia is a great resource. Investopedia.com will have information about these account types as well. I believe you can't go over $2,000 a year on that one though, so it has a limit. UGMA, UTMA also have limits. I think 14,000 and change, give or take, or close to 15. I have to double check on my numbers on that, so don't quote me on it. That's like gift money for your kids. It's almost like a trust you're setting up. So Custodial Roth is one of them that's quite popular. People like to set up. UGMA, UTMA, no age restriction after the age of 18 or 21. It goes into the name of the child though, until then you are the custodian. And then the Custodial ESA account are the ones that you can open for your kids. Do your homework though. Sometimes when kids enter university, some of these accounts may affect the scholarship or the loan, that they can get against what they have already saved up in these accounts as well. But that's at a later time to consider, but be aware of it.
Awesome. Well, so we can conclude this event here after 90 minutes. Thank you, Brother Saad, for hosting us and joining us. It was a great PowerPoint. And thank you, everyone, for tuning into the YouTube live stream. And thanks, Hamzah, Siraj, for helping out with this event as well.
No, thanks so much, guys. It was my pleasure. I hope it was useful for everyone. I hope it was beneficial. And again, as a community, we can only be as successful as we want to be. Those will be my last bits to say. So don't shy away from investing. Sharia compliant products are available out there. A platform like the company I work for was built for people that are millennials, Gen Z, and even our parents. And get in a habit of having difficult conversations with your parents as well. Talking about money. I grew up in an environment where money was not discussed. What was discussed was get your degree, work, buy a house. Pretty much that was it. Stability. Taking risks, work. Talking about difficult subjects like money, savings, estate planning for parents is necessary. Sometimes our parents might learn better from us as well. So get in a habit of having those conversations with them as well.
Perfect. No, again, Jazakallah khair, Brother Saad. And I thank everyone who joined us. A huge thank you from the YM Professional Development Team. And keep a lookout on future events that we have coming, inshallah. And Jazakallah khair again. Thank you so much.
Assalamu alaikum. Thank you so much for having me.
All right. Assalamu alaikum.
Alaikum salam.